talk about properties of commodity investments. Before we begin, we're going to give a brief introduction about this topic. So, commodities, it doesn't matter if they are related to food, energy, or metals, they are very important in our everyday life because the commodities are the basic building blocks of the global economy. And the trade of this asset is one of the oldest forms of the human activity. In previous years, the commodities were considered a non-traditional asset, and nowadays they are becoming one of the major investment assets considered by investors because they are interested to diversify its portfolio beyond stocks and bonds, like they are the classical assets. And this is because the commodities tend to move in the opposite direction of equities. So when equities get a loss, you can get recovered because with the commodities. And it's common that for an individual investors, they are not so interested in this because, moreover, that they don't have the knowledge. The commodities have uh, the commodities have a bulk nature, so it is more common that the companies that are dedicated to food production or in the airline industry, they tend to rely on the commodities to guide their business. And well, the production and consumption of the commodities depends on many factors such as the supply and demand, but also they are influenced by social, political, and economic events. Also, they are influenced by the weather or the dollar, and this is because the majority of the commodities uh, are priced in the US currency. So the commodity prices can fluctuate a lot and they tend to be very volatile. So it's important that when you invest on them, that you try to keep an eye in the performance of these commodities when you are trading with them.
So now we're going to talk about a little bit of the history of commodity trading. The history of commodity trading started all the way back in Japan in the 1600s with the trade of rice. This type of trading started because rice producers will harvest and store their product in a larger warehouse to consume later in the year. Merchants started to trade by harvesting and storing rice, and in exchange they will receive a rice ticket. As time passed, merchants eventually started to trade these rice tickets as a regular currency or equivalent. As more and more people started to use the rice tickets to trade, rules and regulations aimed to standardize this vehicle of trade were put together. Another ancient civilization that had a primary way of commodity trading were the Sumerians, approximately in 5500 before Christ and 5000. Instead of rice tickets, they used clay tokens with a stamp of a boat filled with the number of goat promising. In Spain, for instance, due to the prohibition of usury by the Inquisition in the Middle Ages, Jewish merchants started to loan money against their selling rights of their crops and ensuring their delivery to the wholesale buyers. For example, also in the United States, futures trading started in the 9th century. The Chicago Board of Trade that exists today was created in 1848 when advertisement was published in a newspaper looking for merchants and businessmen who would like to form a board of trade to the fast-growing city of Chicago. A meeting took place at the W.A. Whiting office. A few years later, when a canal that connected the Great Lakes with the Mississippi River, a whole new commerce arrived at the city, and their commodities such as cattle and wheat would be traded easy. The New York Coffee, Cotton, and Produce Exchange will be created in the late 1800s. Currently in the US, there are more than 10 commodity exchanges, amongst them the Chicago Mercantile Exchange, New York Mercantile Exchange, New York Commodity Exchange.
There are several reasons as to why investors have begun investing in commodities more and more over the past few years. One of these is that commodities act as a hedge against inflation. This is because returns on commodities tend to increase with inflation. in contrast with equities and bonds. Also, commodities can diversify against equity risk. This is because they have a slight but positive correlation with equities, which allows them to reduce the volatility in equity-based portfolios. Investment in commodity markets have increased due to the fact that there have been new and more easily accessible commodity investment structures available to investors. This has allowed more investors to find a suitable instrument that will allow them to gain access to these commodity markets. Exchange-traded funds, or ETFs, can be thought about as baskets of securities that allow investors to gain exposure to large amounts of assets. These funds are exposed to the commodity market either by holding them in physical storage or by owning commodity-linked securities or contracts such as futures. Investors who own ETFs do not own a physical commodity, but instead they own sets of contracts that are backed by a commodity. Some advantages of this investment vehicle include that they are easily traded on the market, much like stocks. Investors do not need to know how to buy more complicated commodity investments such as futures or actual physical commodities. Commodity investments, ETFs, are also have low fees, which is also advantageous. A couple of disadvantages that they have is that gains of individual assets may be diluted by the large amount of assets that each ETF might own. Also, not all commodities have ETFs to represent them. Therefore, they cannot be exposed to the entire commodity market through this vehicle. Mutual funds operate much in the same way as ETFs, as they also represent baskets of investments. However, in this case, mutual funds pool the monetary investments of investors, which then share the gains and losses as the fund's prices change over time. Mutual funds can also be actively or passively managed. When they are actively managed, they attempt to beat particular benchmarks or indices, whereas passive funds simply attempt to match them. Some advantages mutual funds have are that they are highly diversified. They attempt to match indices or benchmarks by diversifying their assets. They also have high quality managers, and also even though they are less liquid than stocks, they still retain a lot of liquidity as they can still be traded daily. A couple of disadvantages mutual funds have are that they have elevated management fees due to the high quality managers that they have, and also that they have an indirect exposure to commodity markets. This is because diversification drowns individual assets' performance over periods of time. Futures contracts are commodity derivatives in which legal agreements are made between a seller and a buyer in order to purchase or supply a fixed amount of a commodity in a future time at a predetermined price. The amount of the commodities are standardized in order to facilitate the trade of these futures contracts, as well as the fact that the price are standardized and made and calculated by using mathematical formulas that take into account a variety of factors in order to determine how much is a fair price for that commodity in the future. This is done in order to hedge against price fluctuations in commodity prices, which is one of the advantages futures have. Another advantage futures contracts have are that gains are perceived by the investor directly, as futures contracts are very, very, very closely linked to the commodity market due to the nature of their existence. A couple of disadvantages, however, are that they are highly speculative investments, as investors are constantly trying to determine whether or not the future price of oil, for example, will be higher than the futures they have purchased. If so, they can make a profit. If not, they will lose money. Also, another disadvantage is that due to the close link between the commodity market and the futures contracts, losses are also entirely perceived by the investor very easily. A more indirect way to invest in commodity markets is through equities of commodity-based companies. The mechanics of it are simply purchasing equities of companies that produce certain commodities. So, for example, oil. If you believe that you want to invest in the price of oil going forward, then you would invest in a company that produces oil, such as Royal Dutch Shell. This is some advantages that this method have are the low cost of investment due to the fact that you're simply buying equities on the stock market, which are very simple to do for experienced investors. They are also very easy to trade due to the fact that they are on the stock market. There's a lot of access to information, personal brokers, and the trades are very liquid. A couple of disadvantages is that there are lower levels of correlation between stocks and the commodity in and of itself. This is due to the fact that different companies may under or overperform amongst each other. Therefore, there is not a direct correlation between commodity prices and the value of a stock of a company that produces said commodity. The final investment structure that we will be discussing today is perhaps the simplest in terms of conceptually. However, implementing it may be one of the most difficult. It is called direct investment, and to put it in layman's terms, it's when an investor decides to buy a commodity and store it and then sell it. Some advantages that this method have are that certain commodities, such as precious metals, hold value relatively well in time. So sometimes some people purchase this during recessions in order to help hedge other risks that they confront during recessions. There are also no intermediaries in ownership. The investor is the sole owner of the commodity that they hold, as well as the fact that it has a positively diversifying element when used in small quantities within larger portfolios that contain other investment strategies or other financial assets. Some large disadvantages, and one of the primordial reasons as to why direct investment is not as common, is because of the storage costs, transportation costs, and transaction costs that come associated with direct investment. For example, if you were to buy 10,000 barrels of oil, you have to have a place in order to store that, which may not be practical or not even possible for you as an investor, as well as expensive. Transportation costs are also important because you have to sometimes moving these assets may be very difficult. For example, palm oil, I know that is very difficult to transport as there can be no contact with water or even the air. And transaction costs as well, because whenever a person is going to go buy a commodity, there can be a markup that's around 2%, which ends up being very expensive when you start purchasing commodities very frequently. Therefore, this is why commodities have not been that as attractive in the past. However, the other investment vehicles we have mentioned have really helped people invest more directly and more into commodities.
First, the commodity trading is the process of transporting the raw material from the production place to the consumption place. Nowadays, commodities are becoming an attractive asset to invest in for investors. There are many reasons for this, but one of them, an important one, is that they have been performing well on the long term. And now, the question is, what commodity should we invest in and how to invest in it? How to invest in it, we have previously seen the vehicles to invest in commodities, and for this we're going to see an example taking the Goldman Sachs Commodity Index to see how it is composed and the categories of the commodities it has. So here's the example. First, this is the composition. We can see that the majority is of energy, and there is agriculture, livestock, industrial metals, and precious metals. Then, if we move on to the energy commodity, we can see that energy has been considered an important investment because it is very necessary for human life. So it doesn't matter if it goes from the crude oil to the energy resources. There are always investors that are interested in making profit of this type of commodities. They can include like crude oil, natural gas, coal, nuclear power, electricity, solar power, wind power, and ethanol. In this graph, we can see that energy tanked in 2014 and then it started to partially recover. However, in the following years, specifically nowadays, we can see that the WTI and the crude oil have suffered enormous losses because of the coronavirus crisis. We can see that the price of the oil included in the energy commodity um, has been in its lowest price, and this is because the organization of the countries that are in charge of the petroleum or the oil didn't give a response to the price weakness, and the problem was that the demand was was lower than the offer, but the people didn't stop the production, so there was not an equilibrium, and then the price went to its lower level. And we can see that these type of commodities are influenced by geopolitical factors, economic factors, and since they are very influenced by this, the way the coronavirus crisis develops will determine how this commodity will will be performing the following years, the following months. The metals is the other category of the commodities. This category has been very important for the human development from years ago, and nowadays societies have improved the process of production of these metals, and because of that is now that the investors are able to include these metals in their portfolio, and then they have been able to generate significant returns of it. The metals include gold, silver, platinum, steel, aluminum, copper, palladium, nickel, and zinc. Now, in the graph, we can see that the metals have been losing strength. This is because the demand is slowing because the economy of the major buyers, these ones are China, US, and Europe, is slowing down. So this means that the economic growth is falling, and because of that, the prices are being pressured, and although it seems like there is a loss in the price of the commodity, this is good news for the long-term investors because, as we said before, the commodities are a good inversion in the long run. So if you invest now, it means that the prices in the future will recover, so you can make profit of it. Now going to the agriculture and livestock total return. Um, the agricultural products is the other category of the commodities, and this is considered that is the most essential in the human life. And the production of these agricultural products represent solid opportunities for investors because there is going to be always a demand of it. And the traded agricultural products include coffee, cocoa, sugar, orange juice, corn, wheat, soybeans, soybean oils, soybean meal, leaf cattle, feeder cattle, lean ox, and frozen pork bellies. Now, in the graph, we can see that the demand for this kind of products has been slowed down since the 2008 financial crisis. And as we see, it got recovered in 2010 to 2011, but following there is another fall, and this is because the China economy affected trade and commodity prices. In in the three graphics, we can see that nowadays in 2020, in the last period, in the last month, there are happening losses in general of this type of commodities, and this could be because of the current coronavirus crisis.
So, we think that one of the most important things today to talk is the US oil prices. I don't know if you know, but humanity is facing today a global crisis. Biggest markets, such as the oil one, have been suffering a lot. For example, the WTI crude took a huge drop regarding his future price for June. Just to stop this pandemic, the demand for this product stopped almost at 100% and turned negative for the first time in history. Storage tanks, pipelines, and tankers rapidly being overwhelmed by a vast oversupply caused by slumping fuel demand as countries are locked down to slow the spread of the coronavirus. Soon, future contracts that expire may be selling at $20 per barrel, but as for it seems, May future contracts will have a price of negative 38 per barrel. As said by Oliver Jacob, managing director of Petromatrix GmbH, once you have negative prices in crude oil, the limits change totally. What happened was extremely bad for the confidence in the future markets. It is not just back to normal trading anymore, it's a confidence breaker. So, in essence, producers are paying buyers in order to take off their hands to the oil barrel because of maximum storage capacity. It's unlikely that companies sell at a negative price, so the accurate scenario is that they will close their wells. This coronavirus pandemic set a history point in the oil market. As professionals in the market say, there is a before and after due to these negative prices. There's no way to say that today pandemics doesn't affect the worldwide economy. The spread between Brent crude and WTI crude is normally 50 cents per barrel, but as stopping demand for oil hits so hard, it's now around $8 or $10 per barrel.
So talking about indexes right now, of course there are many that are renowned in this commodity trading world. But first of all, to get the importance of the indexes, these are very useful tools for investment, obviously. So when an investor wants to measure the performance of a certain commodity or a basket of commodities, he can get support with several indexes to track how it is going. So a commodity index tracks the price of a futures contract of an underlying physical commodity on a designated exchange. So to talk about a little bit about the most renowned main indexes, first of all, there's the Bloomberg Commodity Index. This one is calculated on the excess return basis and reflects the commodity futures price movements. So this index is weighted 2/3 by trading volume and 1/3 by world production, and weight caps are applied to the commodity. This is weighted. This rebalance is made every year, and the roll period is typically from 6 to 10 business days, but based on the roll schedule. And another very renowned index is the Goldman Sachs Commodity Index, or CSGI, total return. It tracks the performance of 24 futures contract. It's a production-weighted index because it assigns different weights to different commodities proportional to the current global production quantity. So as we saw before, for instance, the Western Intermediate oil in Texas, the WTI, has one of the largest shares in the production of futures contracts in commodities, and there are some that have a very little share of the production, of the global production. So this gets weighted in 24 commodities. Another important one is the UBS Bloomberg CMI Composite USD Total Return. This index is designed to provide diversity across commodity maturities. So its average amount is deemed to be investment into each standard constant maturity and rebalanced monthly. And the Rogers International Commodity Index total return. This one tracks the commodities among different indexes. It includes traditional commodities, but also some exotic commodities such as silk and Atsuki beans. And of course, there are many more. There are many more. Depends on the interest of the investor, of the basket, or the particular commodity futures contract that he or she has. But there's some. Here are some of the most important ones. So now to talk about the hard and soft commodities. There are of course many more to track the price of the commodities, as there are many commodities. But these are some of the most important ones and the important branches or baskets of different type of commodities there are. For instance, in the energy part is the WTI crude oil, the West Texas Intermediate crude oil. It has one of the largest share of production and trade volume in the commodity trading world. Also, the Brent crude, the BOB, the RBOB gasoline, the natural gasoline, and the heating oil. That's a seasonal one. Talking about precious and industrial metals such as gold, the gold spots, silver, copper, and platinum are also very significant in this particular period of time of economic um, closure. This is a very hard time for the economy of the world. And they're said that the gold is the currency that holds one of the most secure investments in recession periods. So it's very important to track the performance of gold. Agriculture, and there's corn, wheat, cocoa, cotton, and live cattle. These are some of the most important ones, but of course there are many more.